Welcome back to What's Hot, What's Not, C.R.E. It's Wednesday, March 18th, and today the Fed announces its rate decision. Let's break down what it means for commercial real estate. Let's jump into What's Hot. The 10-year Treasury sits at 4.21% today. That's down from 4.28% last week and 4.31% a year ago. That stability is incredibly constructive for CRE deal flow. The sweet spot for unlocking transactions remains that 4.0 to 4.25% range, and we're right in it. Cap rate spreads are holding at attractive levels. Multifamily Class A is pricing at 4.5 to 5.25% cap rates. Industrial logistics sits at 5.5 to 6.25%, and grocery-anchored retail is strong at 5.75 to 6.5%. These spreads support positive leverage for well-structured deals. The Fed is widely expected to hold rates steady today at 3.5 to 3.75%. Now, markets are pricing in just 1 to 2 cuts for all of 2026, which is a far cry from the 6 cuts expected just a year ago. But here's the key. Stable rates mean investors can finally underwrite with confidence. No more chasing a moving target. As a result, transaction velocity is improving. Colliers and CBRE project U.S. CRE transaction volume to reach $562 billion in 2026. That's up 15 to 20% year over year. That recovery is directly tied to Treasury stability. Now for what's not. Inflation remains sticky. February CPI came in at 2.4%, unchanged from January. Core inflation held at 2.5%. The Fed's 2% target is still frustratingly out of reach. Energy prices are a huge wild card. The Iran conflict is pushing oil higher, and the Fed acknowledged geopolitical uncertainty in its last statement. If energy spikes further, rate cuts could be off the table entirely. Some analysts are even floating the possibility of rate hikes. So, hopes for aggressive easing are dead. The market now sees 0 to 1 cuts as the base case for the year. If you're waiting for sub-4% treasuries to finance deals, you may be waiting a very long time. So why does all this matter? Treasury stability is unlocking deal flow, even without significant rate cuts. Cap rate compression will be gradual. CBRE expects industrial to compress about 40 basis points, retail 35, multifamily 25, and office just 20 from their recent peaks. The message is clear. The days of cheap capital are over. Underwrite at current rates and focus on income. And that brings us to the investor takeaway. Don't wait for rate cuts that may never come. The 10-year at 4.21% supports positive leverage for quality assets right now. Focus on the cap rate spread, not on rate predictions. The window for acquiring well-priced assets at these attractive spreads is open now. Thanks for tuning in. See you tomorrow. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.